Have you ever wondered why some companies thrive while others fail? Research indicates that only 20% of startups survive their first 5 years. Now, consider this scenario. Company A and Company B, both semiconductor manufacturers, began operations in the same year and achieved a $10 million turnover in their first year. Fast forward 5 years, and Company A has gone bankrupt, while Company B's annual turnover is now in the hundreds of millions. What's the key difference? The answer lies in their cash flow statements. Welcome to the Finance Virtuoso channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. In this video, we'll break down business cash flow, helping you better manage finances for success. Now, let's dive into our first point, understanding the essence of cash flow. What is cash flow? Cash flow, in simple terms, tracks the movement of money into and out of a business. This includes not only actual cash, but also cash equivalents like assets such as buildings, machinery, and warehouses. Essentially, it's the total money that comes in and goes out. If a company consistently generates profits for shareholders and has a structure ensuring positive returns for years, its cash flow is healthy. Conversely, if a company struggles with dividend payouts, accumulates more debt than profits, and faces financial strain, its cash flow is unhealthy. Think of it this way. Imagine owning a kitchenware manufacturing company. You earn money from kitchenware sales, which covers worker salaries, supplier payments, personal expenses, and business loans. If the incoming cash adequately handles these commitments, your cash flow is healthy. Cash flow can be divided into two types. Positive cash flow. When a company experiences positive cash flow, it signifies that the company is adding to its cash reserves. In other words, the company is earning more than it's spending. This outcome offers the opportunity to reinvest in the business, distribute dividends to shareholders, and manage future debt payments. Consider a company with a yearly revenue of $100 million, but expenses totaling $65 million. This leaves the company with a surplus of $35 million. From this surplus, dividends can be paid to shareholders. Additionally, a portion of the profit can be allocated to acquiring equipment and other investments that contribute to the company's long-term growth and earnings. Next is negative cash flow. When a company's expenditures exceed its earnings, it operates under a negative cash flow. It's possible for one company to generate more revenue than another in the same industry and still have negative cash flow, while the other maintains positive cash flow. Consider a company named Daz Diamonds. Despite generating $200 million in revenue for the year, its total expenses amount to $230 million, resulting in a $30 million loss and negative cash flow. Now let's look at another company in the same industry called Jazz Jewels. With a net revenue of $150 million and expenses of $110 million, Jazz Jewels achieves a positive cash flow of $40 million. Interestingly, although Daz Diamonds records higher sales and revenue, Jazz Jewels prevails in profitability and sustainability. As a result, Daz Diamonds could potentially face closure in the near future, while Jazz Jewels might be on the path to becoming a prominent success story. The cash flow statement. The cash flow statement, often referred to as CFS, is a financial statement that presents a comparison between the total money entering a company and the cash leaving it. This movement can include actual cash or its equivalents. The cash flow statement provides insights into how a company manages its cash situation, illustrating how it generates funds to meet financial commitments. It's a mandatory component of a company's financial reports. The cash flow statement encompasses various types of cash flow. Number 1, operational cash flow. This category covers funds generated from core business activities. For instance, in the example mentioned earlier of your kitchenware company, all cash stemming from manufacturing and distributing kitchenware belongs here. This income caters to worker salaries, operational expenses, and your personal financial needs. Number 2, investment cash flow. This type relates to cash either earned or spent through investment activities undertaken by a company. It encompasses investments made in other businesses and capital asset transactions, like buying plants or equipment, often aimed to expand the company. Such investments can enhance shareholder value and company worth. Number 3. Financing cash flow. This class involves cash received through debts owed by external entities, or cash paid out for debt repayment. It encompasses actions like issuing bonds, selling stocks, or selling loans. A business facing a cash flow crunch due to the inability to meet obligations could even lead to bankruptcy if the situation persists. Number 4. Free cash flow. While not one of the 3 major cash flow types in strict terms, free cash flow holds high value for investors. It emerges when a company's capital spending is subtracted from its operational cash flow. This measure showcases the funds remaining after addressing obligations. Investors find it valuable as it provides insights into a company's profitability and financial health. Remember, understanding these cash flow categories is vital for managing personal or business finances. It's like having a roadmap to guide you through potential financial emergencies, ensuring stability and success. Robert Kiyosaki's explanation of cash flow. Renowned author Robert Kiyosaki, known for his best-selling book Rich Dad, Poor Dad, offers a clear perspective on cash flow through what he terms the cash flow quadrant. Kiyosaki breaks down people into 4 distinct categories. 1. Employees. 2. Small business owners, self-employed or specialist. 3. Big business owners. And 4. Investors. Kiyosaki recounts his upbringing, where his real dad aimed for him to be an employee, where his mother encouraged him to become a medical doctor, reflecting the first 2 categories. However, the person who significantly influenced him was his rich dad, not a biological relative, but his friend's father. This rich dad emphasized becoming a big business owner and investor. The 3rd and 4th categories, which Kiyosaki considers the path to wealth. A big business owner is someone who constructs a company with up to 500 employees. An investor, on the other hand, is an individual who has shifted from owning businesses to investing in other enterprises. Investors don't need to involve themselves in the day-to-day operations of the companies they invest in. Instead, they generate income from those businesses. Notable examples of big business owners include Mark Zuckerberg and Elon Musk. Individuals in this category typically experience the least tax burden and have the potential for substantial growth of their wealth. In contrast, those in the 1st and 2nd categories often bear the heaviest tax load and might struggle financially if their responsibilities increase over time. While there's nothing wrong with being an employee or a specialist, aiming for higher aspirations is encouraged. One effective approach is to save money from earnings in the initial categories, enabling investments that yield both income and passive revenue. To elaborate further, Robert clarified the definitions of assets and liabilities. While many have traditionally considered their cars and homes as assets, Robert offers a different perspective. In simple words, he defines an asset as something you own that brings in money, while a liability is something that takes money away from you. For instance, owning a home and a car often involves monthly mortgage and loan payments, therefore draining your financial resources. To cultivate a positive cash flow, the focus should shift to investments that generate income without requiring additional effort. Robert suggests considering real estate or other investment opportunities that yield cash after expenses are deducted. For instance, imagine purchasing an apartment building valued at $1 million without any initial investment. If the property generates $15,000 in monthly revenue, while expenses amount to $11,000, covering loan payments and taxes, you would be left with a positive cash flow of $4,000 every month. This is passive income earned without extra exertion. To follow Robert's advice, it's wise to minimize liabilities while concentrating on growing your assets. Positive cash flow from assets can pave the way to financial freedom and the construction of lasting wealth. And that's a wrap on cash flow and its impact on not just businesses, but on your personal finances as well. Before you go, don't forget to give this video a thumbs up and share it with anyone seeking valuable financial insights. Your support helps us reach more people on their path to being financially virtuous. Thank you for watching.